I think it's important we get to understand what volatility is all about, what stock market volatility is all about. In actual sense, stock market volatility can be seen as a double-edged sword for investors. It is driven by various factors, including economic data, corporate earnings, geopolitical events, and market sentiments. Volatility is often represented by it is represented numerically by indicators like the CBOI, or rather the CBOE volatility index. We have the VIX, which is commonly referred to as fear index. So this particular instrument is used to measure volatility. This indicator measures volatility. We need to ask ourselves why volatility matters for investor. Why does it really matter? When it comes to investing. Number one, we consider risk assessment. Risk assessment. Having asked ourselves why volatility matters, we need to consider number one, risk assessment. Volatility helps investors, gauge the risk associated with, with a particular, stock or a broader market or the broader market. Stocks with high volatility might experience dramatic price swings, signaling, higher risk, whereas stocks with lower volatility tends to be more stable. They signal stability. Number two, opportunity for gains. Opportunity for gains. High volatility often presents trading opportunities, particularly for short-term traders, swing traders, high-frequency traders. So short-term traders such as swing traders, day traders, high-frequency traders, they may exploit this price swing, this volatility in the markets to make profits. However, this approach requires skills, it requires experience, and the capacity to tolerate or to bear risk, because statistics indicate that over 90% of traders don't make money. They don't make money consistently. That is the stark statistics when it comes to trading. Number three is portfolio diversification. Portfolio diversification. By understanding volatility, investors can craft a balanced portfolio. So low volatility instruments like bonds, like dividend-paying stocks, and even cash can offset the risk of high volatility assets like equities, like stocks, and it tends to stabilize returns over time. So you could craft a portfolio that will include both high volatility assets and low volatility instruments. Number three is portfolio diversification. We've just done that. I want to look at number four, market sentiment indicator. Market sentiment indicator. So volatility actually reflects market sentiment. It is market sentiment that produces market volatility. So a spike in volatility often indicates fear or uncertainty among investors, while declining volatility, suggests confidence. It signals stability. Number five is risk management. Risk management. So long-term investors they tend to use volatility metrics to adjust their strategies. For example, they might increase cash holdings, or more they may shift their investment more to safer assets during periods of heightened volatility to protect their portfolio. In a case where the market becomes more volatile, it's advisable you shift your investments, more of an investment from, high risk equities to kind of lower risk, more stable government bonds. So your analysis of volatility will help you to be able to, uh, you know, shift your investment strategy as a proactive measure against losses that will arise as a result of market volatility. Number five is number six rather. Number six is correlation with economic events. Correlation with economic events. Volatility often rises during major economic or geopolitical events. For example, during financial crises, during wars, or sudden changes in monetary policies, the market becomes more volatile. So understanding this can help investors anticipate potential market movement. If you really understand what causes volatility and the likelihood of increased volatility, that will help you to craft your strategy to mitigate the effects of this volatility on your overall portfolio. Please like this video and subscribe to this channel so as to motivate me to keep on bringing contents of this nature to you. So strategies to navigate volatility. So what strategies are we going to adapt to help us to navigate market volatility? Number one is stay diversified. So spread investment across sectors, across geographies, and across different asset classes. Number two, you focus on long-term goals. You focus on your long-term investment objectives. That will help you to stay disciplined, and it will help you to avoid reacting to short-term market noise. That would often not really have a very long-term impact on your portfolio. So you use stop loss orders, particularly if you are a trader. You incorporate stop loss order. This can limit potential losses during sharp market downturn. When you implement a stop loss order, it means that your portfolio or your stock, as the case may be, will not go below the price at which you put your stop loss. If the stop loss is $2, when the price gets to $2, the system automatically sells off your stocks, and so you cannot go below $2. So consider low volatility ETFs. So for cautious investors, and these funds offer exposure to stable stocks with lower price fluctuation. These are exchange traded funds, designed to typically mitigate against high volatility. So they incorporate low volatility stocks into their overall portfolio. That gives you the advantage of being able to mitigate the impact of volatility on your overall investment returns. So stock market volatility, in summary, in conclusion, is an inherent aspect of investing. We can't do without it. It's inherent, just like babies cry. Babies cry in the stock markets experience volatility. While it may seem intimidating, Understanding its causes and implications can empower investors to navigate the market more effectively. So aligning their strategies with their financial goals and risk tolerance. So it's very important you understand volatility and the impact on your portfolio, and how you could go about mitigating these impacts.